For more on the markets and what it means for your portfolio, we welcome in David Stryzewski, CEO of Sound Planning Group. David, always good to see you. Thanks for joining the show.
Appreciate you, Caroline. Great to see you.
So, David, instead of focusing on the weakness that we're seeing this week, let's focus on next week and one of the key reports that we're going to get on inflation, of which, of course, is the personal income and spending, and as part of that, the core PCE price index, which we know the Fed closely watches. The hope is that inflation continues to moderate, gets closer to the target. But I was taking a look at your notes, and you say the inflation cycle will have a lot more life in it than Powell and the markets are expecting. How does that play out?
Okay. Well, I have a different thesis on why inflation is occurring right now than I think Chairman Powell has. And that derives from the fact that Congress is printing and spending right now at a rate that is unprecedented. You know, Milton Friedman actually really solved this problem back in the day. And he said, you know, where is inflation? In economies that are printing money. And so what a lot of people may realize is that we're above 33 trillion as a nation right now in total debt. But what many do not realize is that since the debt crisis ended just before Independence Day here, we've added $2 trillion of additional debt to the bottom line, which is the equivalent of, and oh, by the way, 650 billion just in the last 30 days, 650 billion in a month. So we're looking right now at a spending spree that is ultimately the only thing, in my opinion, that is really keeping the economy going. And so as we see the continual printing, and you just connected here about banks, you know, I have big concerns about these banks and where they're going to be headed, and the margin compression that's absolutely there because they no longer have capital to lending with. The rates are so much higher. Lending standards are so much more stringent. It's very challenging for capital markets right now to be effective in doing some of the things that we've seen in the past. So I think that we're going to see some inflationary things, especially with the price of gas going up and the Saudis and Russia kind of being in lockstep with all that and looking at depreciating the amount of barrels on a daily basis. You know, so you know, the oil production's one of those things that's going to cause inflation, but this deficit spending is out of control, unfortunately, and you know, that leads us to having to print more treasuries. And really the reason why we're seeing these treasuries rise as fast as we were, and I wish Powell would have addressed this, but he didn't say it as straight, and you know, it's part of his job actually. But it's because, you know, the Fed's no longer buying treasuries. China's no longer buying our treasuries. They're buying gold, by the way. Institutional investors are no longer buying our treasuries. And in Japan, our number one creditor is tapering off of that as they're looking to control their own yield curve. And so bonds are just a supply and demand factor. You know, if the sellers want to sell, the United States needs to print a whole bunch. If the sellers want to sell more than the buyers want to buy, the price goes up. And so I think that that's going to have to continue on because we're not seeing a high demand right now for people just excited to jump into the U.S. dollar as we're looking at a November 15th you know, date here on having to have a House Speaker and budgets passed, or we go into another one of these shutdowns. So again, this is just not a peachy or rosy moment, in my opinion. I think a lot can go wrong from here.
Okay, so let's talk about what going wrong a lot going wrong looks like, because if spending is keeping the economy going, but it's also keeping inflation high, does that mean we'll see more rate hikes, which will eventually push us into the recession?
Okay, so I think Powell is essentially out of ammo at this point. He doesn't know, he didn't want to raise it more because then he'll be, you know, in trouble for raising it too much. He doesn't want to cut because that's the Volcker mistake that we saw in the 70s, and that's what caused inflation to just go through the roof. So he's not going to do either. He's waiting for the lag effect, which generally takes, you know, 12 to 18 months to happen. He's waiting for the lag effect to show up. I just think that we're going to run out of time. And so, yeah, if banks have challenges, we're going to print. You know, that's the tax of least resistance, by the way, as well, you know, because we really should be, you know, cutting our budget. That's really hard. You're not going to be raising taxes going into an election year. And so what's the answer? We're just going to print. So are we going to have to raise rates higher? I think that the bond market's actually already doing some of that for us. He may have to raise rates higher. I'm not really sure what that game plan is, because we're in uncharted waters today. But as far as the challenges go, I mean, we're slowing down right now in production. If we just, look at all these union strikes that have been occurring this year, that's indicative of how the average investor is doing, how the average person is doing. They're not asking for more wages because they think CPI is going to go up in the future. They're having a difficult time making ends meet today. And so they're trying to say, hey, we need more money if we're going to be able to do this. And they've got that power. And so obviously higher prices to pay employees and smaller work weeks is going to bring the prices up, which is inflationary. For reshoring or friendshoring from China, as we recognize that challenge, well, that's inflationary as new infrastructure costs are going into place. And we're also, probably paying a more livable wage than we could pay. China was paying their people to be able to produce certain things. And so I see a very larger problem here today. And that stems from what Jerome Powell's already done. And so because he flipped the entire credit cycle, which for 40 years was just able to go down and down and down, now everything changes. And the reason why everything changes is because everyone is dependent on credit. Our system has been reliant on cheap money for more than a decade. And so that's gone. That's out the window. I don't think it's ever even returning. And I don't want to be a big bear that everyone's like, wow, this guy is the most negative person in the world. My vote is it goes back. I think everything pre-2020 was awesome, okay? But the reality is things have adjusted. And because the credit cycles touch every part of our market, I see this going to be as a rolling recession. I think we're going to have downturns and downturns and downturns as different parts of our economy face different challenges and weaknesses as it's sort of reshaping and restructuring. And we're globally having a lot more challenges as well with supply chains.
All right, so we're almost out of time. So I do want to just get to what this means in terms of your investment strategy. You say It's all about riding bulls and taming bears. So how are you riding bulls and how are you taming bears in terms of what you're doing to your portfolio?
Well, number one, I think that's a good title for a book that's going to be coming out here pretty shortly. I'm about 35 days from done with that. But so the goal here is to understand, know when to hold them, know when to fold them. When should we be in? We need to understand how cycles work. Cycles happen. It was a buyer's market. It's a seller's market. Okay. So we need to understand how do we deploy capital today in a way that's going to avoid the big challenges that we're going to have in the bond market. Many people are conservative today and they're loading up with bonds. And I'm going to say that is a very, very, very well, that might not be the best idea, just given some of these challenges that we have with higher rates, et cetera. So how are we doing it? Well, we need to be more individual in our allocations. We need to be specific in understanding how is the world changing here in the 21st century. And the world's changing right now because, tech has been this great leader. And I definitely think we're going to see tech companies, continue to improve, and AI is amazing, and biotech's amazing. There's going to be some great breakthroughs. But if we look at where the S&P 500 is based on capitalization, only about 14% of the S&P 500 today is based on like commodities and like oil, gas, different metals and different miners and different places. It was about 50% in the 80s as we were ending this inflation cycle. So what I believe is going to occur is that we're going to see more of these commodity-based companies begin to get greater strength. They're going to become a lot more valuable and important because we're still building things, especially with the green new things that are happening. There are metals, there are commodities, there are things that are critical for infrastructure. And so I'm more allocating to ideas like that as an investment strategy. But it's really important to be hedged right now, because money seems to be made like an escalator, little bit by little bit over time, but it seems to also be lost like an elevator when things get bad. And so what we have to avoid is these major downturns, especially if we're nearing or entering retirement. And so, just wrapping that thought up, it's things like gold and silver, it's things like copper, it's things like uranium, it's things like gas right now that are ultimately going to get the United States into a position of strength. And they're ultimately going to give us the tools that we need to be successful in the future.
All right, David Stryzewski, CEO of Sound Planning Group. Always appreciate your insights. We'll keep an eye out in 35 days for that book. Thanks so much.
Appreciate it. Thank you.